that gives a lot of ammo for the Fed to kind of take their foot off the gas here. And in that case, the markets will go boom.
Hey guys, welcome back to Library of Wealth. Today we have Chamath Palihapitiya giving us his assessment for the current inflationary market, as well as the inevitable recession that looms in the background. With the Fed driving interest rates higher and higher, Chamath discusses how the financial markets will be affected by the uncertainty globally and what the next year could have in store. Chamath has been very specific with his market predictions within the past year, up to and including exiting several of his positions. The billionaire investor has shifted his investment thesis more towards stocks, and this has led to warnings for investors to be aware of the market conditions following the Fed rate hikes and the current inflation we're seeing. Please stick around till the end of the video as Chamath gives us his predictions for the last half of the year and what to expect with stock and financial markets. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
We still had some amount of rate uncertainty from the Fed. I think people weren't sure how aggressively they were going to hike. But by early this week, it was pretty clear there's going to be two 50-point hikes, one in June and one in July, and then effectively a pause, because then the Fed funds rate will be at around 2%. And everything from there will probably be path and data dependent. Okay, that's effectively what they said. Now, I think the markets had actually already started to see that writing on the wall. So if you go back to, one of our favorite measures, which is the 10-year break even, it's effectively rolled over, which means that from the highs in sort of late April, it started to come down, which says that, they were thinking that, the inflation was not going to be as bad in the back half of the year. And then the second is that corporate credit, which is really what matters in some ways to the Fed, because that's where they can intervene. What is the spread above treasuries that a company can issue debt? When it goes crazy and it goes up, it means, oh no, the cost of capital is going up. That's going to be hard for companies to raise money. They may have to lay people off. They may need to get into cost-cutting mode, right? That's what goes through everybody's mind. But that's also now about 35 and 40 days rolled over, which means that the gap has started to shrink, between the US Treasury price and what, decent corporates can issue debt at. So it looks like we are set up for potentially a decent little rally here. The problem is it a rally that is sustainable? Or is it a rally that's basically what we call a dead cat bounce or a bear market rally, where, you just get some 1 or 2 weeks of relief before the thing spears down again?
Chamath says that investors need to be careful about the accuracy of reported earnings by giant companies like Facebook and Google, because if the earnings aren't correct, then the risk is much higher when an economic downturn happens. The slowdown expanding could lead to dangerous market volatility.
So right now we're in a moment of pause, and there is the potential, if this data comes back as reasonably good, which means prices are, not escalating as much as we thought, inflation is not going to be as bad, growth is going to be moderate. That gives a lot of ammo for the Fed to kind of take their foot off the gas here. And in that case, the markets will go boom.
Well, the costs of buying a home are going way up because home loans are now more expensive. So that's going to factor into all sorts of consumer purchases. Anything that's financed is going to be more expensive. You're also seeing companies starting to slow down spending, really starting to slam on the brakes. We see it in startup land. Startups are all slashing costs right now, but that's eventually going to percolate up to big companies too. You saw Dara's memo, basically when he got back from Wall Street. Remember, he published that a couple of weeks ago saying we need to sharpen our pencils, cut everything. What Wall Street is looking for now is free cash flow. It seems to me like we're headed into a pretty serious downturn or recession here. I mean, I've been saying we're in a recession for months. The tricky thing for the Fed is that they don't have a lot of good options, because we have a lot of recession indicators blinking red right now. At the same time, inflation is still high. So they're kind of caught between a rock and a hard place. I think what the Fed should have done is, in 2020 hindsight, is back last summer, we first got that shock CPI print. Remember, it was like 5.1%. Seemed to come out of the blue because for years and years we've been talking about deflation. Nobody thought inflation was a problem. All of a sudden we got that 5.1% print, they were in total denial about it. They just dismissed it, saying that inflation was transitory. And, Yellen said the same thing. And so basically everyone just ignored the data for 6 months. What they should have done was stop QE right then and there. They could have taken a little bit of time to think out, a rate increase strategy, but they were still basically engaging in QE for 9 months after that, first inflation warning. And if they had stopped QE there, then we wouldn't have had this asset bubble in the second half of last year. That's when it inflated the most. And we could have had more of a soft landing. Unfortunately, now they kept inflating, and really until the end of Q1, and they've yanked away the punch bowl so violently that I think the real economy is going to go into recession. So that's where we are right now. I mean, I don't know what the right answer is now, given that we're in this almost stagflationary position.
I think we're in a pretty reasonable place here. The real question is now, what do you need to take the market lower? And this is more of a nuance, but when you look at companies that are now quote unquote cheap, right? Let's take an example like we hear a lot about Google or Facebook, right? And people will say, my gosh, this is cheap, because if you run a screen on it, it's like 10, 11, 12 times price to earnings. Well, the price because you can look on the screen. The real question is, are the earnings right? And the thing that can take the market lower is if you actually think earnings are modeled incorrectly, right? So we saw it this week as well. Snap, completely just blew themselves
46% down intraday yesterday, I think.
I just want to say something about Snap.
In one day.
They have the most incredible propensity to self-immolate on earnings calls than any other company I've ever seen. There's probably been 3 times, no less than 3 times over the last 4 years, where I don't know whether it's just poorly scripted or not well rehearsed, or the people that are helping Evan get ready for these things, but these are disastrous calls. Facebook's had a couple in its lifetime, but Snap consistently, probably once every 18 months, will do this. The thing just completely implodes. The stock implodes by 48% or something. And then it, rolls over to companies like Facebook and Google, who then are off 8 or 10%. My point in telling you this story is that if you think Facebook and Google, just as an example again, are cheap at 10 times, well, you better hope that the earnings are right. Because if the earnings are actually wrong, that's actually 27 times and 19 times. I'm making these numbers up to give you the example, because the earnings are fundamentally wrong. So that's the risk now that's left in the market, in my opinion, that could take it much, much lower, is if that, all of this slowdown really contracts spend and the earnings are actually not accurate. The forecasted earnings will need to be revised over the next 2 or 3 quarters, and that's where we will probably see the low. If, however, growth is muted and the Fed can, as Brad said, it's a really good analogy, now just course correct by degrees, a degree here, a degree there, we've probably consolidated the lows.
What happened? Over the last couple of years, we had $10 trillion of money printing, right? Why did they do that? They thought that they could stimulate our way out of this COVID recession that they had induced with lockdowns. In any event, the point is they thought they could stimulate economic activity by printing money, and maybe cynically, politically, they thought it would be good for them in the midterms. What actually happened? That 10 trillion goes into the economy, but there's no corresponding increase in the output of goods and services. So 2 things happen. First, price levels rise and we get inflation. And second, we get an asset bubble in the stock market. And then the way both those things sort of come crashing down to earth is the Fed looks at this inflation and suddenly has to jack up interest rates. That pops the asset bubble. It vaporizes something like 14% of global wealth. And then simultaneously, workers feel a lot poorer because their wages haven't kept up with inflation. So this whole idea that you can just print money as a way to create wealth and prosperity, I hope what we take away from this, I think, recession that we're going into is that is not a viable strategy. The only thing that creates wealth in a society is the output of goods and services that people want. And you just can't try to sort of play games with that by creating this sort of phantom money that doesn't represent a real increase in goods, services, or productivity.
Chamath says he believes inflationary drag on growth stocks will ultimately end and that deflationary forces will return. The Federal Reserve is focused on keeping inflation under control, which has investors concerned as the U.S. economy sends mixed signals regarding market development. While you might expect greater discussion about the Fed delaying interest rate hikes, all indicators are that the Fed will be less market reactive than in the past. All signs point to a volatility in the global markets, the likes of which we haven't seen before. But what do you think about Chamath's take on the market conditions right now? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.